Okay, let's move on here and let's get back to a topic that has captured the headlines when the Dow sold off an unprecedented 900 points on the May 6 flash crash. High-frequency trading, widely criticized as one of the contributors to the crash, now it accounts for 70% of all U.S. equity trading. 70%, that's according to December data, and that is a record high. Let's bring in Themis Trading's Joe Saluzzi, who's been very vocal on this topic. Joe, in terms of these numbers, it seems like this really brings us back into the crosshairs and that regulators would be taking a look at it.
Yeah, unfortunately, Senator Kaufman left. His office, his term was done, and kind of the regulators in D.C.'s kind of quieted down somewhat. The issue hasn't gone away. The market's been up since the end of August, right? And everyone's happy that it's going up, so no one really is looking at this. This is still brewing out there, and I think the number you just mentioned, 70%, it's been debated by some people, but that tells you right there that the trading ecosystem has changed. No longer do owners of the market set price and find that price discovery point. It's now set by renters, hyper-speed traders, 22-second holding periods, who at the end of the day, they go home flat. They could care less what a company does. So the question that we've had is the price being accurately reflected, or is it just these guys chasing it?
I mean, aren't all investors to some degree renters of the market? It's just a matter of the term of the rent, because the companies, fact of the matter is the companies go public. They sell their shares, they raise their money, they go ahead and do what they do, and then everybody else who comes in is a renter of those shares.
Well, that's correct. But you guys on your panel here, you guys talk about stocks all the time, whether the earnings are good, oil's going up. You have a thesis, you have a theory of why you're buying a stock. These guys don't care. They're chasing momentum, okay? And they're chasing intraday price inefficiencies between asset classes, whether it's options, futures, or stocks, and they're just looking to profit or penny or and that's fine, okay? It's no problem. But the problem is the ecosystem, again, when the institutional holder no longer sets price, you have to question valuation.
And Joe, to your point, I know one of the points that you bring up also is the same problem I have with this, and where I think high-frequency trading has to be looked at more harshly, and that is the people that are peeking at the orders prior to them getting to these dark pools in particular. If you're willing to interact with orders of a certain percentage guaranteed, then you get to peek at the order that no one else gets to see. Now that sounds like a rigged game to me, and I can't believe that the SEC and the rest of the regulators might not be all over this thing.
Right. And John, the point that the other side will make is that this is fair for everyone. You can all co-locate, you can all add to these data feeds, and the answer to that is no. Let's be realistic, guys. Even now, amongst the high-frequency community, they seem to have a fight going on between the small and the larger. The larger ones are eating their lunch. The smaller guys now have a problem with the sponsored access rule coming up in a few months. So the bottom line is, who pays the biggest ransom to the exchange to get that co-located server, to buy their market data feeds, to get those ports? Those are the winners. Those are the ones with the faster peak than the other guys. But is that really a fair market? I don't know.
All right, Joe, got to leave it there. Thanks so much. Joe Saluzzi of Themis Trading. Got to take a break. More halftime reports straight ahead.